Investing isn't easy, but it's also not as hard as you might think. I think the problem that most people have is that they simply don't know where to begin. In the next few minutes, I'm going to help you get started. I'm going to break investing down into 5 relatively simple steps. Think of this as setting the foundation of a house. So let's get started. Step 1, research things that you know and understand. This was Peter Lynch's advice from the 1980s, and I completely agree with it. If you're in the computer field, you have an edge in technology. If you're a lawyer, you have an edge in public companies that support the legal industry, like companies that provide information to lawyers. I would recommend that you use what you know as a starting point to find investing ideas. Step 2. If you find a promising product or service, figure out whether the company that makes it is public. And if it is, read the company's latest annual report. You can find this report on the SEC website or on most popular financial websites. It's known as the Form 10-K. Now, it might take you a few hours to go through. Initially, maybe 3 hours, and it will be slow at first, but it will get faster over time. The report will have a lot of information to help you get up to speed on what the company is doing. The risk factors section of the report is especially important. This section will jog your thinking on things that could go wrong in the company. Step 3. When you are thinking about a company and deciding if the company is something that you want to put on your buy list, list out the pros and the cons of making an investment in the company. Now, the pros will jump out at you. You will likely know all the things that the company could do that are positive. After all, you're familiar with the product or service and you're excited by it. But the cons are just as important. Understanding what could go wrong is critical because often that's exactly what happens. This is where the risk factors come into play. Be very thoughtful about those risk factors and how realistic or probable it is that the company will trigger some of those risks. You should be aware that the lawyers basically throw all risks into this section without really indicating whether something is probable. So it's kind of like a kitchen sink approach. So you don't have to worry about every single one. But over time, you will be able to see a pattern and you'll be able to discern the risks that seem out of the ordinary. I would recommend that you do critical thinking to counteract any confirmation bias that you might have. And what I mean by this is just if you have a thought, whether positive or negative, you go one step further by thinking about counter arguments or weaknesses of each thought. Step 4, after you do your analysis, which you should write down, if you feel that it is a company that you would potentially buy, don't just go out and buy it. Doing the basic research is one part of it, but the other really important part of investing is valuation. Peter Lynch teaches a relatively simplistic but effective way of valuation. And backing up, valuation is just a fancy term for ensuring that you don't overpay for something that you want to buy. Peter Lynch recommends that you value a company by looking at the growth rate of earnings. The idea is that the PE ratio of the company, the price to earnings ratio of the company, should be less than the growth rate of earnings. So let me give you an example. If a company is growing and you believe the company will grow earnings over the long term at a rate of, say, 20% per year, then what you want to do is you want to buy the company at a PE of less than 20. Now, admittedly, this is going to be very conservative, and there are going to be many times during a bull market when stocks are very expensive, and it's actually, you won't find very many stocks that meet this criteria. But you have to be patient. And that's when step 5 comes in. Step 5 is to wait for an opportunity. To be a successful long-term investor, you have to be patient. Doing nothing, sitting on your hands, is a core competency. And if you can't find any companies that are reasonably priced, what you should do is focus your time and your energy on doing more research and finding more companies to potentially invest in. Keep adding companies to your buy list so that one day when there's a market correction or one of the companies that you're interested in misses earnings or something happens that causes the price of the company to drop below your valuation price, at that point in time, you can go ahead and buy that company. The lesson here that most professional investors have learned is that you want to only commit your capital when you are relatively sure you're going to make money. And that means being very selective and avoiding questionable situations. We do that by buying companies after setting a conservative, reasonable price, and then only buying the stock if it sells for less than this price. Warren Buffett ranks companies in 3 buckets: yes, no, and too hard. In my experience, most companies should be in the too hard category, and there will be lots of companies that are obvious no's. But there will be only a very few companies that are obvious yeses. What you want to do is you want to be very sure that the opportunity is worth taking, and that requires being very, very patient. Now, I appreciate that the nuts and bolts of actually doing the 5 things that I've just mentioned may be a challenge. I also obviously haven't covered everything that you need to know, such as how do you figure out whether the long-term rate of a company will be 20%? Well, keep watching our other videos where I will elaborate on some of these basic concepts and give you more information on becoming a great investor. Thank you.